In recent years, the U.S. tax code has undergone several important changes that have significant implications for both businesses and individuals. These modifications are designed to simplify tax reporting, incentivize certain behaviors, and adapt to the evolving economic environment. Understanding these changes is essential for taxpayers to navigate their financial responsibilities effectively. Here are the top 10 recent changes in U.S. tax laws that affect businesses and individuals in 2025. 1. Corporate tax rate adjustments. One of the most notable changes in recent years is the shift in the corporate tax rate. The Tax Cuts and Jobs Act of 2017 slashed the corporate tax rate from 35% to 21%, but in 2025, discussions about potential tax increases for corporations are ongoing. The Biden administration has proposed increasing corporate tax rates, which could directly impact businesses' profits and tax liabilities. If passed, these changes could lead to higher tax burdens for large corporations, influencing their investment decisions and pricing strategies. 2. Changes to capital gains taxes for high earners. High-income individuals are facing potential hikes in capital gains taxes. The current long-term capital gains tax rate of 15% to 20% may be subject to changes, particularly for individuals earning over $1 million annually. The proposed changes aim to align capital gains tax rates with ordinary income tax rates for high earners, potentially raising taxes on investments, including stocks, bonds, and real estate. 3. New tax incentives for renewable energy investments. To encourage green investments, the U.S. government has introduced new tax incentives for businesses and individuals investing in renewable energy. Under recent tax law updates, businesses that invest in solar panels, wind turbines, and electric vehicle infrastructure can claim expanded tax credits. This is part of a broader push to combat climate change, offering opportunities for companies to lower their tax burdens while contributing to environmental sustainability. 4. Enhanced Child Tax Credit. The Child Tax Credit, CTC, has undergone a significant expansion under recent legislative updates. The credit is now more generous for families with children under the age of 18. In 2025, the CTC has been increased to up to $3,600 per child for children under 6 years old and $3,000 for children aged 6 to 17. This change provides a direct benefit to individuals, helping families offset the rising costs of raising children. 5. Changes to the standard deduction. The standard deduction for both individuals and married couples has increased in recent years to adjust for inflation. In 2025, individuals can deduct $13,000 and married couples $26,000 from their taxable income, up from previous years. This increased deduction simplifies tax filing for many taxpayers, making it more beneficial for individuals who do not have enough deductible expenses to itemize. 6. Corporate minimum tax for large companies. The government has implemented a minimum tax for large companies to ensure that corporations with substantial profits but little to no tax liability pay a fair share. Under the Alternative Minimum Tax (AMT) provisions, companies earning more than $1 billion in annual revenue must pay a minimum tax rate, even if their deductions or credits reduce their tax liability to zero. This change is aimed at addressing concerns that large corporations are avoiding taxes altogether. 7. Expansion of Earned Income Tax Credit, EITC. The Earned Income Tax Credit, EITC, is being expanded to benefit more low and moderate income working individuals and families. Under the 2025 tax reforms, the eligibility for the EITC has been widened, allowing more workers to claim the credit. Additionally, the credit amount has been increased, providing a greater benefit to those in the lower tax brackets. This expansion is aimed at reducing poverty and incentivizing work among low-income earners. 8. Elimination of the Stretch IRA provision. A key change for individuals planning their retirement savings is the elimination of the Stretch IRA provision. Previously, beneficiaries of individual retirement accounts, IRAs, could stretch the required minimum distributions over their lifetimes. However, new legislation requires that beneficiaries withdraw the full balance of the inherited IRA within 10 years. This change could significantly impact estate planning strategies, particularly for high net worth individuals who have relied on this provision to extend the tax benefits of their IRAs. 9. Expansion of 529 college savings plans. Recent changes to 529 college savings plans have expanded their use beyond traditional educational expenses. Starting in 2025, taxpayers can now use 529 plan funds for qualified apprenticeship programs, student loan repayment, and even some private K-12 education costs without facing penalties. This gives families greater flexibility in how they utilize their savings for education-related expenses. 10. Increase in tax audits for high-income earners. The U.S. government is investing more resources into auditing high-income earners, including individuals and corporations, as part of a broader effort to ensure tax compliance. In 2025, the IRS has increased its focus on auditing returns from individuals earning over $400,000 annually and large corporations. This effort aims to reduce the tax gap and ensure that wealthy individuals and businesses pay their fair share. In conclusion, these recent changes in U.S. tax laws are reshaping the financial landscape for both businesses and individuals. From tax credits and deductions to new investment incentives, staying informed about these updates is essential for effective financial planning. As tax laws continue to evolve, it's important to seek professional advice to navigate these changes and optimize your tax strategy.